Hello, my name is Sarah Bush, and I'm at the Morningstar ETF conference. Today I'm joined by Jerome Schneider from PIMCO. Thanks very much, Jerome, for joining us.
Thanks so much for having me. Appreciate it.
So I thought maybe we could start off, since we had the Fed announcement yesterday, just by getting an update on how PIMCO is thinking about rates these days.
Well, we're obviously in a transformational phase of the Fed. We're going to potentially have quantitative easing, which has now been articulated as finishing over the October timeframe. And, as we see, there's an improving job economy. We're obviously focused on wage pressures. That's what Chairman Yellen is focused on right now. And that obviously translates into how robust the economic cycle is going to be. It's going to be a reflexive positioning for the Fed, meaning they're going to have to think about how all these factors come together and ultimately how they're going to have to tighten rates. So we're still thinking it's mid-2015 in terms of rate tightening. For investors, they're going to have to think about how the markets react to this information. And although the language remained markedly the same yesterday, we did get some clarification on what the exit plan was going to be for the Fed ultimately. And so the stimulus as we know it, the growing of the Fed's balance sheet, is going to begin to subside and eventually abate. And that's going to obviously have impact on various markets around the place. More importantly, it's going to focus on the volatility within the markets. That's going to be a primary focus for investors going forward. And what that really means is you need to find attributes, risk attributes within your portfolio to accentuate, to help provide income, to help provide safety and performance, and more importantly, total return, and de-accentuate those that might contribute a little more volatility to the market. And so for us, thinking about duration is one, or interest rate exposure is one that you're going to have to actively manage over the short-term horizon, the cyclical horizon, as the U.S. economy improves, which we believe is going to improve over the next year. But ultimately, thinking about how what we call the new neutral over the next 3 to 5 years translates into an investment thesis. And we believe that ultimately the ultimate rate will be around 2% at that point in time. But that doesn't necessarily mean that the Fed isn't going to overshoot rates or undershoot rates. That's something that investors are going to have to contend with over the next 6 to 9 months until we ultimately get our first rate hike from the Fed.
So let's talk a little bit about how you're putting that into practice with portfolios. We've noticed that PIMCO short term has been run with a pretty short duration relative to where it's been historically. Where are you finding value, and how are you thinking about that rate positioning?
Exactly. And then I think what we have to think about is ultimately the reaction function of the marketplace. For me, short-term investors want to think about two things. They want to see a portfolio that obviously has a performance beyond money market funds, so above zero interest rates. Well, anybody can do that. You could obviously go buy a high-yielding asset or a longer duration asset, which has a yield. But what we really need to think about is total return. Just because you're earning a yield on a security doesn't necessarily mean your total return is the same on the security. You could own a yield in a high yield bond in 2008 that might offer a very attractive yield, but your total return would be quite negative. So we need to be thinking about two things. One, a total return aspect, and two, thinking about it in terms of what us as bond geeks think about it as Sharpe ratios, or volatility adjusted returns. And when doing that, you can find very good opportunities in the short end. So for my portfolios, I find better opportunities in credit. The U.S. economy is improving. We can find better opportunities thinking about ways that demand for liquidity is in the marketplace. And for me, I really focus on the liquidity markets and effectively what I call alpha generation or excess return generation through collecting liquidity premiums, finding ways that are mismatches of liquidity within the market and putting those into the portfolio so that we can basically harvest those excess returns. And then the third thing is look globally for opportunities. Look globally to deploy these assets in high credit, high quality situations with improving economies. And one of those which we've partaken for this year in our portfolio was Korea as an example. Again, a AA, single A type of economy, improving metrics, good, strong balance sheet. And Korean companies shared that benefit as well. So we've been able to benefit from that. So as we think about our positioning, we want to think about items such as financials or improving those industries with improving economics to the home industry. For us, that's our focal points for the immediate future. And then ultimately, we're going to think about ways to participate in a higher interest rate environment. And that could be understanding, looking out the yield curve in terms of roll down and potentially adding duration back at a future point in time. But until the Fed clearly gives us that delineating factor of that first hike and the market recalibrates to that, duration for us in the short-term portfolios at least is something that we need to be very tactical in utilizing.
Okay. I want to ask you just one more question. Since you're focused on the short end of the curve, I'm sure you've paid a lot of attention to money market reform. Are there any opportunities that's opened up for managers in this space?
Absolutely. The key point that many investors, whether you're institutional or retail, have missed over the past 40 years is that liquidity management has remained static. And now all of a sudden it's changed. We talk to treasurers and CFOs of Fortune 500 companies who really haven't fully understood that over the next 2 years, the constitution of how a money market fund works, moving from a $1 par NAV to a floating rate NAV, is going to change markedly. And there's an accounting ramifications and tax implications and frankly liquidity implications. So for investors moving forward, they used to find safety and importantly income in money market funds. That's no longer going to be the case. Two reasons. One, money market funds are going to have a increasingly subdued amount of supply that they can invest in. There's going to be an abundance of cash in the short end and fewer and fewer assets they can invest in. So that's going to create a supply-demand mismatch. So rates structurally are going to remain lower in money market funds type of assets, even once the Fed starts increasing rates. The second thing is active management. We need to be thinking about how to deploy investment opportunities beyond what the regulatory constraints are of a 2a7 SEC money market fund. Now, there's valid reasons to invest in money market funds, but for investors thinking about how to tier the liquidity, the money market fund segment is only one aspect of liquidity management. Looking to short-term, low-duration type of strategies, such as our PIMCO short-term fund, or our Mint ETF, or our low-duration ETF, which we just launched, Elder, we can utilize opportunities with active management that balance risk and reward, and most importantly, offer an active approach to liquidity management. That's the key thing that investors need to think about, that the conditions to manage liquidity, which they've thought about for the past 40 years, have distinctly changed and will ultimately change forever in 2 years from now once money market regulation is implemented.
Great. Thanks very much, Jerome. Thanks for joining us.
Thanks for the opportunity.